Welcome to Pet Business Disruptors. I'm Clayton and I'm here today with Scott Kirby, who is the co-founder of Compare Funding. And yeah, thanks a million for coming all the way to beautiful Peterborough.
No, thanks for having us. It's a pleasure.
A lot of people, I think, when they think about the pet industry, I think we talk a lot about how investors and finance is really shaping it. To be honest, I think as it is a lot of SMEs. Um, So yeah, just tell us about what you do, what your journey was, and yeah, what you sort of do for companies.
So I'll try and not send you to sleep because coming back to my background, chartered accountant by trade originally, many years ago now, qualified at 20, straight out of college. Worked for an accounting practice firm and kind of came up with this really simple, kind of life-changing kind of epiphany of going, why do you're an accountant, you're in practice, you deal with lots and lots of clients, but yet you're advising them. How can you really advise businesses if you've never been in business yourself? And it kind of sent me off on this journey of I've kind of worked for a variety of different companies since. So I've worked in the travel industry, motor industry, variety of different companies at different stages and size, and I think I've learned quite a lot. Just before COVID's when I decided to get involved in more of a tech perspective and more of my own kind of background, which led me really around to fundraising. Compare funding is really about providing businesses of all size and all industries transparent access to funding. So what I mean by transparency is in the commercial finance world, a lot of funding is generated by brokers and introductions. Um, but the problem with that, and it's kind of a legal case that's going through the courts, is really around the disclosure of commissions and the incentives behind why certain products or certain lenders are promoted at certain points in time. So, what we're trying to do is help businesses access cash that's right for their business, but making sure they also understand the true cost of that and making sure it's something that's right for their business. We've been working on that for a period of time. We also help businesses looking for equity funding, so in terms of by reviewing business plans, offering advice, support, really with a view of trying to help more businesses access cash because cash is key not just to surviving, to scaling, and all those other things. And there's obviously a variety of different ways to support businesses. Um, and a lot of people think sometimes that raising equity investment is the only way to kind of grow and scale, when obviously depending on the industry and the business, debt financing and grant funding and all those cover other areas can help in just the same way. So really important to understand and distinguish between the differences.
Yeah, I think that's the thing is what we've seen obviously in the pet industry is obviously there's been a huge amount of equity financing at the lower levels. A lot of new brands have popped up as a result of this equity financing. Um, and I think like for the more sort of let's say the more older traditional businesses, there's been like a bit of stress and like they've been like yeah, there's money just being thrown in, and I think um, what we've seen is we had the COVID boom of this happening. So like 2020, like during the COVID years, there just seemed to be tons and tons of investor monies who were just throwing money in, but that seems to have dried now in the last year or two. Um, I think and again, I might be being slightly glib about this, but I think you only had to have half an idea a few years ago to get funding, whereas I think now that the market has changed enormously.
Massively, and I think that now it is incredibly difficult. And it has been more recently as well. I think it's getting ever tougher. I think the stats came out maybe earlier this week or last week of really that the first quarter of 2025 has been the hardest environment going back to 2017 of when companies being able to raise cash. And that's because what's driving that? There's a huge amount of investor demand in AI based businesses. So if you think there's a definitive amount of capital at play and more of that is getting segregated into other industries, then all those other industries that make up the remainder, it becomes ever squeezed. But I think there's also that other thing of where maybe even 12 months ago, you could come up with half an idea and have some meaningful, kind of a little bit of validation around the edges. And you could find a couple of angels and they'll go, oh, yeah, I'll back that. Whereas now, more and more, you're getting to that stage of where people want to see a product. They want to see that next kind of stage of the journey and go, okay, cool. Well, you've overcome most of the risk because ultimately investing is about risk and
Yeah.
where you sit on the journey because it's long term, isn't it?
Yeah.
And now it's that expectation for what you have to have done and delivered. You can have a really great product and you've kind of gone through that pain point, and then it's like you need cash to scale because you've proved a concept. And depending on the nature of the business, the need of why that is, if you're a retail business, it's suddenly great. I've got this massive demand for the product, but I've then got to go and obviously pay the manufacturer to manufacture it, get it all there, and there's a big working capital cycle off the back of it.
Yeah, I think also it's funny you obviously just the AI thing. I think like that's the one thing which people are sort of still semi obsessed about, and I think things like moving cycles that you'll have. Like I've been involved in the insect industry, and I think like if you look at the insect industry 5 years ago, everybody wanted to be involved in it, and now everybody's like checking out of it, going like we don't want to put any more money into this at all. And I kind of see AI a little bit similar, is that everybody comes up with these claims that I'm going to get into AI for the pet industry, let's say, but then there's all these weird and wacky things coming out like apps and different things. But actually, when you look at user case and like how it's actually going to like shake down in terms of products, most of them aren't going to survive. But there does seem to be a lot of stuff getting funded at the moment just based on being AI.
Yeah, and I think there's also maybe more in the pet industry of the you go where it's a classic retail product. That the only way they're going to scale is be retail, and you've got people trying to market it at the early stages of being a D2C product
Mm.
because everyone goes, well, that's recurring. You've got subscribers, you've got this, and it leads to a higher revenue, kind of a higher revenue and potentially a higher valuation. But more and more investors now, like, not that they weren't before, but they'll pay more attention to these things and go, that may be great that you've got a D2C offering and it's subscription based and all that. But for this business to scale and be anywhere near the kind of value you're claiming it to, it's a retail business through and through because that's where the majority of people buy these products. And therefore, the biggest barrier you then got is the cost of acquiring a customer if you want to scale a D2C business.
Yeah. One of the metrics I was obviously interested to find out is look, I come from a background where it was all about EBITDA, so earnings before income tax, and then you put a multiple on that, and that's the value of your business, and that would vary between how involved you are, how removable you are from the business, and that sort of stuff, how mergeable that is into other businesses. But now you have, like I say, that we've seen the last 5 years, everybody's obsessing over subscribed businesses because it's about recurring revenue, and I was actually surprised to see the metrics on that because I mean, look, if we look at Tails.com, that was an absolute basket case of an independent company, but huge subscriber base merged into Nestle, it becomes very profitable. And we've seen a lot of the subscription businesses, obviously, people talk about Butternut Box and Different Dog and all these other companies, and they're all sort of following that same line. But there has to be a cutoff for this because you can't just run uneconomic businesses which are just based on, well, we're just going to keep throwing tons and tons of money into customer acquisition, and we don't care if we're losing money hand
Well,
over fist.
I think that's also the biggest thing that's changed in the landscape, and not just in the pet industry, but across broader things, is that investors want to see now more. There's a route to profitability. There is there used to be huge amounts of money that would go, do you know what? As long as we're acquiring customers and we're growing at a certain rate, then the access to funding would always be there because as long as you're on that journey, you're getting to that point. Whereas now I think there's much more of a maturity of that, of going, yeah, but when are we ever going to get to a point of it becoming profitable?
Uh,
Because all that time you're continually spending, you're reliant on the fundraising journey, you're reliant on the external market of what's going on and everything else. And that presents a massive risk that you could suddenly go, okay, it could be a really good business that's just because of the way it started from the beginning, that it's always been very aggressive in terms of you're raising money to spend it to grow. But if growth suddenly stalls or the market downturns or some of these other things, you're then in a really difficult position. And there's been other businesses where they've grown like that, and then they end up having to cut back significantly.
mm.
And I just think there's a lot more attention to these things now than what there were. And it really is about understanding that and also making sure with all these things it's planning. So if you're whatever kind of stage of your journey on, if you're not planning and understanding where you are, and the time frame it takes for some of these kind of things to happen, then that's always where your risk is far greater.
Yeah, yeah, no, that's what I mean. It's interesting to see how the market's changed. And look, I've had dealings with VCs before, and the trouble with I always found with VCs is that they want shit or bust whenever they talk to you. It's sort of like, okay, if you're honest with them about the market size and say, look, realistically, there's a lot of building out that's got to happen along the way. It's not just a case of you throw us a shitload of cash and we just like spend that and we show the marketing metrics that there is a natural limit to this. They're not really interested. So I feel like there's always been a lot of companies who have just sort of obviously, tried to blind that side of it, just to get the huge amounts of money. But it's a dangerous game dealing with these companies.
Yeah, and it's also about understanding and doing the maths that for a VC to make money out of something and the level of risk and the size of the bets they obviously place, then you're looking at for them when you start a journey to 5 years time, you're probably looking at there's got to be an opportunity to make 100x.
Yeah.
So if you're starting on day one and you think your business is worth 5 million quid, that means in 5 years time, really, is it capable of being a 500 million pound business? If it's not, then probably it's not going to be right. And that's a really simple way of looking at it in terms of you look at the different expectations on returns over a period of time. So VCs want really large opportunity to replicate scale, deploy into other markets, new territories, and so on. If you can't get to that kind of scale, you're never going to be kind of a VC target because the numbers just don't work. They make enough bets that they expect to lose on to know that they need a number that do perform at that level to pay for more.
So when you look at it, because I mean, I obviously I'm in the pet industry, like I've always been in the pet industry, and I look at most companies and I say, I don't see many of those that are. I don't see hardly any companies that are ever going to be sort of 500 million pound companies. Even like, so you look at the butternut box model, for example, at the moment. That's a company that's invested 300 million, I believe, into the company, and that's all being done on the back of the acquisition of Nom Nom in the US, which was a $1 billion purchase by Mars. But this isn't the US, and subscription doesn't work in the UK like it does in the US because geographically we're very close together. We don't need to, like, people still shop in stores a lot more predominantly than they do in the US. And you think, who's bankrolling this, to be honest, and who's saying, okay, we can get to this point? I don't know. I look at it and I think, how is that ever going to be? Because if you've had 300 million like put into it, I mean, what the returns just don't sound that good for investors, to be honest, at this point.
No, and that's why there's so few. If you kind of look at the headline stats on what raises money and what doesn't, probably what 1% of all businesses trying to raise cash collect actually raise it. And then you look at the failure rates of those businesses as well. What 80% kind of fail in the first 3 to 5 years.
Uh,
So, yeah, in cases like that, you'll probably find that when they originally did it, they didn't envisage spending 300 million to get to that point. And it's the stage of where people, if you're so far down a journey that you can, but then where that business was acquired by what Nestle, as an example, is it probably for them actually once you're into that environment and you can go at the sort of scale they can suddenly go, that's where it becomes really valuable
yeah,
because all you're doing is repeating it, putting it across a global footprint, and it's saving them do the R&D themselves.
yeah,
So I think that's quite common is where you'll see some like the larger brands allow all these independent players to get to a certain size and then go, great, we can buy that now and we'll push it out across all of our network because that's set up to do it
yeah,
globally.
yeah.
And that's then when they become worth the sorts of quantums we're talking about. But that's incredibly rare.
Yeah, well, that was what I was going to say. Is that these things all sound great in theory? That, like, I'm butternut box, and I say, well, if Nestle bought me or if Mars bought me, they could just plug me into their system. But then you've also got the argument. So I know Mars in the US at the moment are just launching a fresh food product, and I kind of look at that as a way of saying, well, can we do this ourselves? But like, because why would I pay X amount of £100 million for a company when I could potentially do this myself because the market's built, and then just roll it across my current distribution chains? Why would I need to buy another company?
It's probably in a lot of those cases because the cost, if you're Mars, and the cost to go and do something is always far higher because of the corporate ladder and the way these companies are structured. So that's why it can be quite a cost effective way of going, do you know what, they'll try and do some themselves, and they may have kind of their own brands or kind of own R&D bits across a huge vertical of different businesses. When it comes down to it, of then to be able to go, well, we can carry on spending all of this on R&D and doing our own thing, or we can go and buy that company that's already done it. They've got a following, and we know just by acquiring it, one, we can scale it very, very quickly. We can make it far more efficient because we're buying in the sorts of quantums they're buying in. That it's that thing of, I think you'll probably find with a lot of things they try and do it themselves as well as look at the market,
Mm,
and because of the size of the position, the organization they are, they can afford to do both really and see what works.
yeah.
And that's where it becomes more of that thing of going, these are huge sums of money, but the potential returns, if they get it right, are massive themselves.
So for yourself, like when you operate with a customer, let's say I'm a guy comes to you, like you obviously do you deal with investors and with startups or
Yeah, so we work kind of abroad across the board. So we've kind of got a number of different channels. So we've kind of got, because one thing a lot of people overlook is the fact of, if you've already gone through that initial part of the journey, then actually there's a huge number of debt routes that you can use which can fill the holes that come up. So we've kind of got a transparent kind of platform that helps businesses find debt financing. We also have a network of independent advisors that can support and give businesses free advice that's unbiased. So then what we also do is we'll give up our time, we'll host events really around spending time with founders, understanding their business, the real challenges they're going through, and how can we help them raise cash? Because there's lots of challenges or awareness of things that when you actually look at it, the missing ingredient can be quite obvious. And that could be valuation. It could be, do you know what, your numbers don't make sense.
yeah,
And until, I think there's not enough support out there for people where people actually want to invest the time to go through stuff, but then actually provide feedback. It might not always be the best feedback, but I've always kind of had that logic of, it's better to try and help people, even if it's negative,
yeah,
because it is an incredibly difficult journey to get through the other side. And we kind of do that in a variety of different ways of just trying to help people understand where their pain points are and if there's someone in our network that can support with that. So we're
mm,
always trying to build relationships with more investors and also look at where debt's probably a better option. Because you could take, if we took an example of a new pet business, they've got a product range, they've done a little bit of D2C stuff online via their website, and then they get a phone call from Pets Corner or Jollies or one of the big chains, and they go, "We want to put an order for £100,000 worth of this, and we want it at this point in time." Your immediate problem is going, "Well, how do you finance that?" And more people still run straight away to go, "Okay, we need to go and get some investment to do that," rather than thinking, "Okay, if I've got a purchase order essentially in this situation from a high grade client, then you'll find a lot of banks would lend against that, therefore you're kind of breaking that cycle down of, yes, you may pay a little bit of interest, but you're not diluting your business. As well as most investors looking at that situation will go, why are you coming to me looking for investment when actually that's a debt, that's a working capital need?
mm,
Because just providing working capital isn't necessarily where equity investment works.
yeah,
So it's about understanding and kind of breaking the business models down and understanding of what the driver or the want for cash is, rather than, I just want to go and raise cash.
yeah,
So we do lots of things where you go really trying to challenge that kind of need of, what is it you physically need money for? If it's marketing and kind of brand building and those kind of things, then the reality is that is going to be an equity kind of journey. But if it's just a scale and you've already got some traction and validation, and it's really a retail or wholesale business, then there's probably a debt option that works just as well there.
yeah, yeah. Well, like factoring, I remember we looked into factoring years ago. My old business when because we grew massively. We had a competitor go bankrupt, and it blew our sales by sort of 50%, and we were just struggling to, like give credit to be honest, because obviously we were buying some stuff on credit, some stuff we were importing, and the importing stuff you got to buy in advance. And so we did look into factoring the debt to be honest. We didn't do it in the end just because like we were able to, like squeeze a couple of our suppliers for a bit more time. But um, But I think people forget about sort of traditional routes, I think.
Yeah, and I think that one of the biggest things you'll find more and more is this massive stigma against borrowing money.
Mm,
People are quite happy to go and try and raise investment and give away part of their company, but to go and borrow it, it's almost like, oh, it's almost like a bad word. Whereas again in the States, they're much more comfortable borrowing money and leveraging that cash to go and grow.
yeah,
Because that's the thing, there's a lot of established businesses and a lot of industries of where they could grow far more quickly, but they're not prepared to go and borrow money to do it. And then they may look to raise investment or something instead. And again, you look at the stats on that. How many businesses successfully go through a funding round or sell their business or whatever overall? It's very, very low in the scheme of things. Because if you want to go and sell an established business, someone's going to come along, they're going to look at your EBITDA and go, okay, what if that's repeatable? Have you got a succession plan? Have you got all these things? What are your competition doing? And one, it becomes a long process, but there are so many people that don't consider, like, if you've got a successful, stable business, and you go, well, actually, what happened if I could release the working capital from all the customers that owe me money, which
mm,
is kind of where factoring comes in or invoice discounting. And because they're also still quite low costs of capital, because essentially it's secured against the debt. It's unless your customers go bust, which in hopefully most cases they don't, it's an easy way to raise cash back into your business at a low cost. There's all these different avenues of really about understanding what is the barrier or what is holding you back from growing and scaling or from going and invest in something. And the things that underpin all of those is really having a plan in the first place. So where are you on that journey? It's very easy as a startup to go, I've got this great idea. First thing I need to do is go and raise cash. And you then kind of go, okay, great, I've raised cash. What do I do next?
mm,
And sometimes when you've got more money in the account, you suddenly go, oh, we're going to go off and try all these different things that were never in the plan.
yeah,
And that's part of the thing of where people need support is it's really around we start at A, we want to get to Z, and there's all these mini steps in the process and being as efficient as possible to get through them.
and I think look, one thing I have seen like over some of the investment-led companies is the waste they sort of like end up with because they've been given the money and they've got to spend it. So like social media marketing managers, which are on 40 grand a year, when you could like outsource that to another company and get that done for like a tenth of the price and just get what you need. And do you know what I mean? They just absolutely just spend fortunes on lots of different things.
And it's incredible, and that's exactly the thing is, and then it's that you create this need for cash.
Yeah.
Whereas if you go, "Do you know what? If you're as incredibly frugal and you start going through this process and you go, great, I've raised 100 grand. Some people go, I've got 100 grand I can go and spend on this one channel, and we go 100% in on social. Whereas other people go, well, actually, let's take the first 10 grand and let's trial it across 10 different areas and spend a grand in them each. And then you you come back and go, okay, well, that one delivered me 10 grand, that one delivered me nothing. Like, you really want to understand the data behind, depending on the type of business, of what's driving kind of activity rather than the ego and the perception of grandeur that we need to be everywhere over social
Yeah.
media. If people can't see us, it's really understanding that. And I suppose probably the best examples of some of these things is how you get retail versus online, and the way how you still get all these big retail chains that still have a large footprint, but they also have an online business as well. It's understanding that different things contribute, but really being able to track and understand that you don't put all your eggs in one basket. You try a variety of things and be led by the data.
Yeah. Yeah. It's like small risks, isn't it? As opposed to, yeah.
Because it's also that you then follow that logic through. If you go, I've tried these 10 things and the return on the investment of each of those 10 things is incredibly different, to then go into an investor and go, I'm going to actually, we did this test, we spent this money, and this is the results we got. To then go, we now want to raise more money to go and do more of these three things because they work really well, is so much more credible.
Mm,
And you're de-risking that position because you're kind of following the logic and thinking it through. It's not just like kind of a guesstimate of we're going to do this. We've done this. We put it out there. We spent X, Y, and Z, and this is what we delivered. Now we want to replicate that because we proved it worked. We just want to increase the volume to generate more traffic, and that's where it's really like Probably one of the really topical things at the moment is TikTok Shop, isn't it? In
Yeah,
terms of
yeah, yeah.
how valuable that can be as a channel. But again, it still requires a lot of investment in it and to make sure then you've got the stock lined up to make it work. Um, Again, not something I know a huge amount about, but I've
No.
seen more and more coverage.
Well, I think it's the thing is with TikTok Shop is, look, the problem is with all kind of let's say tech solutions in terms of selling, is that they all just become very, very expensive to manage over time and become less and less profitable. And I think where TikTok Shop is still relatively new, it's very profitable for people because the competition isn't necessarily there. The money you have to pay to TikTok is much lower. I mean, look, if you're on Amazon, in reality, to sell the product on Amazon now, you have to be the manufacturer. You like, and you need to be able to give away at least 50 to 60% of your margin on the retail price by the time you've covered FBA, Amazon margins, pay per click, all of these things. And like, and if you don't do all these things, you've pretty much got a dead brand that's sitting on there not doing anything. So you look at Amazon and you think, well, like I look at, because there's a tool you can use on Amazon where it can see how much they actually get down. And you know roughly what their cost prices are. And most people are struggling to make 10%, to be honest, on Amazon sales. And so realistically, if you can find a channel where you can actually get in front of a large audience and actually make money, it's very worthwhile for people. But look, I'm sure TikTok in 3 or 4 years' time will be like Amazon, and like everything else, it will be it will just be flooded, and the margins will be screwed down. To be honest,
Yeah, and I think that's always the challenge, isn't it? But also you're kind of the demographic, isn't it? That TikTok speaks to a much younger audience.
yeah,
I don't have TikTok myself, so you kind of look at that. I don't really have a lot of social media, but it's that avenues of where it doesn't really it's just really about trying something and seeing what works for you and your business. But the point you made there around margin is incredibly important, and it's about really have. There's so many people that have a very loose grip of how much something costs, and I think the tighter grip you understand of your product, how much it really costs at all the stages, you can then be far more flexible with what you spend on certain things because you've got that awareness. The worst thing to do is think you're making a lot more money than you are, spend a lot more money to try and create those sales, then you realize I'm spending a lot of money to lose something
yeah.
because the numbers don't really kind of make sense when you go through it. As well as being continually reviewing what it costs you to make something and really understand those volume points as well. Because again, that might be something that drips out and goes, oh, great, we could make this for half the price what we do today, but we've got our order 5 times as much. And you go, okay. But then that creates a funding need. And you kind of go, well, there might be a way to make that work. Because then you look at the macro kind of factors around it, and it makes a lot more sense, both to an investor or to a lender. Because you're going, okay, well, if scale's the problem there, then we can fulfill that. And then suddenly it becomes a lot more profitable. And that's where it really, with a lot of things, it's about getting to a certain scale to make it viable. Because obviously, low volume, unless it's an incredibly high cost product, is always going to be far more difficult to scale. Um,
And that's the thing. I think also that Amazon and things like that nowadays have been the way of giving businesses scale so that they can make MOQs, make enough products, because and really diversifying your sales portfolio, because if you just did Amazon and nothing else, you're not going to make money as a business. But if you use that as a vehicle to get your volume to a level where you can actually buy the MOQs and turn it around. And I think that's what Amazon's becoming. And like I say, and this is why you need to do everything. You need to do the TikTok shops. You need to be selling through retail. You need to do D2C on your own website. You need to try and you know have as many different strings to your bow as you can just to do it. And I think it's always surprising when you see, let's say, one company and they're like just sort of single channel entities. I think I find it a slightly odd strategy, to be honest.
yeah, and it's incredibly risky.
Yeah,
And we've seen that with you look at a lot of the data behind the scenes from an Amazon perspective, and there's more and more Amazon owned brand products now than there ever has been. that trait continues to rise because ultimately they can see everything that sells and the volume it sells, where it sells it, how much it costs, and they can go, "Do you know what, is there a big enough place there for us to go and do something?" And I think that's the thing. If you only have ever have one channel, it's always far more difficult. But it's also understanding is the why. Why is someone buying your product over something else? And trying to build out more, if it's a brand led kind of concept, of the value of the community that then comes back into it, doesn't it? Because
Mm,
it's not just you're buying this product because it's the best product. It's actually, I want to be a part of something as well.
mm,
But all those things have costs because then if you want to do a community thing properly, you obviously need to activate it, and that has costs attached to it as well.
yeah. And like I say, I think that's the difference, isn't it, between like where you invest your money? Because obviously, look, the reality is, when you start, the further away you get from commodities, and the more you get towards brand, the safer you are in the longer term. But obviously, the more the investment is, because anyone, if if you're buying, I don't know, just let's say a bag of peanuts, for example, like a bag of dry roasted peanuts, and you're just selling basically like a clear bag with some dry roasted peanuts, and that's a long way from selling something which is a nice packet, which has, like a sort of an ethos behind it, etc. So um,
It's
and
also trying to align that with the customer, isn't it? So why is the what's the gap and where's the opportunity? So in that example, why is suddenly someone sitting there going, "Do you know what? I like peanuts, but there's not really Brazilian peanuts
yeah,
as a phrase with a little bit of different kind of flair. Everything is salted, as an
yeah,
example. Well, what we're going to do is we're going to be unsalted, and this is why that. Then you spin it up. Actually, it's a healthy snack now because it's where I think that one of the most important things you can ever do is really that marketing and brand story, but all driven by is truly understanding your customer and making sure that when you stand back and go, okay, are we a premium product or are we a low cost product? That we don't confuse those ideologies,
yeah,
because otherwise that's also the opportunities of where you can end up spending a lot of money on something, but yet it has to be a volume player, which completely contradicts kind of the value principles of something more premium.
yeah. In terms of like funding, is it easier to get funding for um, a brand value product, or for, let's say, a new product conceptually?
Really, it really does vary on the individual story,
Mm,
and the size of the addressable market, like what it is, and I suppose from that perspective, if you've got an established, so you could have a new brand, or you can have an established brand wanting to go and do something different. If you've got an established brand and you're trying to apply it to a new use or a new product, it's probably easier in some senses. But then again, it depends on how the historic performance of those other kind of product lines performed. Whereas new business, yeah, it's more difficult overall in terms of you look at the success rates, but creating something from scratch that's got no history is sometimes a better place to be because you've got nothing you're judged against.
mm,
But that's where it's about making sure the stories make sense. So if you're going to go and do something, it's really understanding, and not just like everyone kind of comes to that habit of going, the first thing I need to do is go and do a pitch deck.
no,
And it's then you get into, I've got 10 slides that tell me I'm going to be a millionaire, and everyone thinks it's as easy as that. But then they fail to go back and actually go, let's validate all these things we're really talking about. So let me sit there and find one of my best things with all these kind of areas is going, if you've got an idea about something, is go and ask as many people as you can about it and validate it and kind of condense their feedback. Because even if you haven't got enough money to go through the journey of actually going and building something and starting it, then the best thing that you can offer an investor is going, I've been and spoke to 100 people. They told me they would buy it, or 90 told me they'd buy it. This is what they would pay for it, rather than me just going, I've got this great idea, this is what it's going to do, and this is what we think we can do for it. If you can get any real validation and real traction, that's so much more valuable than anything else because it de risks it
mm,
rather than everything being an unknown. If you think about accessing investment, really about ticking off kind of risks. So if you think, if we look at kind of our business today, we've probably got three risks. Three main risks of, can we build the product we're trying to sell? Can we get two sides of the marketplace to use it? So, can lenders use it and will businesses use it? And that's broadly it, really. And then you go, okay, so how can I go through? Let's take the second point really. Have we got a strong enough value proposition that I can reference with lenders? Yeah, we have. We've been through every single lender we met, and 100% of them have said they use it and they can see the benefit. Business, you kind of apply that same logic to lots of different things, and you go, of all the things that are unknowns, what can I start to turn into a known, and then how can I quantify that and model it? Because it's all about really traction and validation. So if you go, I'm going to go and buy this product or sell this product, what's it going to sell for? What's it going to cost me? How much is it going to cost me to market it? And you go, what other products have launched recently? Can I speak to someone there? Can I ask them? Will they give me some time and really lay out this is what we're trying to do? And then you kind of are trying to really validate that because the less unknowns you have, one, the more credible you become, but two, the chance of being successful are far greater. And also, if you speak to someone, they go, I don't think it's going to work because of X, Y, and Z, and it makes you take a step back and go, actually, that's a really good point. Then let's remember, like 80, 90% of businesses fail, and such a small percentage ever raise cash. And even you look at those people who achieve life changing kind of outcomes, is very, very small. So the more awareness you can have early on of going where those potential risks are and being conscious of them, and also by understanding there are risks to success isn't a negative. It's about having that awareness. If you know what your problem is, it's far easier to fix it than going, ah, we think it's going to be amazing. And you let the ego and the bravado kind of get you carried away and think, oh, do you know what? It's all going to be all right. Whereas you're so much more credible if you can go, we've been out, we understand, this is what our journey is, and these are all the barriers to us being successful. That's a much, much better place to be.
No, definitely. And look, I do think the trouble is it's hard for people to actually assess that effectively, especially like people who are just bringing brands to market because it's hard to actually get that vision over the market. I mean, like when you get people come to you in terms of brands, like how do they usually start off and what are they usually looking for? And like because I feel like I feel like most people come to you just looking for equity investment initially.
100%. The vast majority of people I kind of come into contact with are looking for connections to access an investor.
Uh,
And it's have a look at the pitch deck, see what we can do, and you then kind of come back to it. And our kind of emphasis of all of this is to take the time to understand a business properly, even if it's not something we can actually directly earn out of or anything like that. Is we will always try and give everyone the benefit of time and experience. And that may be feedback that people don't necessarily like, but the reality is really around I would much rather look at it and kind of assess it as a neutral and go, I think these are going to be your challenges and these are the reasons why, than to just go, unfortunately, we can't help. Good luck. Um, and for whatever reason, I think that's there's a lot of people who will be positive. And again, there's also a lot of problems in the fundraising space itself because there are a lot of people who claim to have large networks of investors. And then you'll get startups that are come to you that are desperate for cash. And they go, and suddenly someone goes, well, if you pay me X per month on a retainer, I'll go out and I'll speak to some people. And you go, in reality, most of those things never work because one, even if I've got a really big network of people that invest in lots of stuff, the reality is you can never guarantee that's going to happen. So there's a lot of people that get kind of the wrong advice at the wrong stage, end up spending a lot more money. And it's the same with advice. A lot of people, you can have a great idea and you can go and spend a lot of money with an advisor and try and validate it. But that doesn't necessarily get you any further forwards.
mm,
Whereas all we want to try and do is go, I think this is your challenge. It might be valuation. It might be the amount of money you're looking for. It might be the fact you're looking for a small amount of money and go into a VC, like the
mm.
paradoxically opposite. So really taking the time to understand where they're at, what they've done so far, can we help them or can we signpost them to someone that can? because different businesses have different needs. And part of that is really taking the time to understand how you can support them and what you can add to it. As well as just being a nice person in a general terms of going, it's far better to reach out to people and have conversations and see and provide valuable feedback than just being a dick.
Mm.
And it's when I say like sometimes you have to be cruel to be kind, the reality is you can say things that are quite factually accurate that some people might take negatively because it is the way it is to a certain degree.
Yeah, I have the same issue. I think sometimes is that like people tell me about their ideas and like you can see that like in its current state it's not going to work, but you've also got to like sidestep around it and sort of like try and drop hints rather than just be like, dude, give it up. Do you know what I mean? Because like you kind of want to, but it's sort of like you say, well, this is maybe you should look at this and maybe look at this and like maybe I'd question your ability to do this, and then I'll point out some other people who've done something similar, and then some people who've failed doing something similar. But it's you because you like people are very invested in what they're doing, and like it's quite upsetting for them to get like a big whammy of
Well,
negative.
it becomes deeply personal, doesn't it? It's the fact that if someone says, I don't back your idea, or I think it's going to be difficult to be successful, you go, wow, oh, didn't like that.
uh,
Rather than going, and again, it's all about delivery as well, don't get me wrong. But if you can go, I think you've got all of these challenges. So, no real working capital management. You've got a really long cash flow cycle. You've not got high enough margin. You're struggling or you're spending too much to acquire a customer. But you've got a really cool brand here, and the way you've kind of built that brand and the community side of it is really kind of engaging because your stats and engagement are really strong. You can then go, well, cash flow cycle, we can probably work through because there's probably understanding that in a bit more detail of what the barriers are. There might be a funding option there. Margin, let's really understand what your product costs. Is there ways that we can do that? Or are you just selling it at the wrong price?
mm.
Because some people get it fixated on this mindset and you never take a step back and go, why are we charging that price for it? And I think that's where you can get premium products that still try and sell at a much lower price range than where they need to be.
Yeah, I think it's also like there's an element of like naivety, I suppose, on how the product distribution system works, I think. And it's a bit like, look, if you looked at Amazon, it costs are about, I don't know, 10-15% to sell on Amazon, but that's not the real cost of it. Do you know what I mean? And I think it's sort of like people think, well, if I'm producing it for £1, I can sell it for two, and I lose 15% to Amazon. But then they can't ever get past a certain point. They can't distribute it. They can't get a distributor involved. They can't get retailers involved because there's no margin for anybody left. And so then they end up like boxed into certain channels. And the truth is the price probably didn't need to be at that level anyway. It's just they've set themselves up into a situation where they thought, oh well, look, my nearest competition is like twice as dear as me, but they're twice as dear as you because they've got everything built out,
Yeah.
and they've got a marketing spend built in. They've got all these pay per click costs built into their pricing.
Yeah, and I think that's where it comes back to really understanding your data.
Right.
And depending on what it is you build, it's uniform to anything. So it can be a product, it can be a service, it can be digital product, kind of retail product, whatever it may be. It all comes back down to that same thing of understanding how much it costs me to make it, much does it cost me to distribute it, whether it's a physical product or get it out to the consumers online, and then what am I leaving myself to actually make some money out of it. Because if you're not really that good at kind of tracking those things, you don't have to be an Excel wizard or kind of any of this stuff, but really those basic kind of core drivers. And plus, if you do all of those things and you start into those conversations with investors or other funders and all this kind of stuff, having that knowledge is so powerful. Like how many times do you see on Dragon's Den they suddenly go, let's go through your numbers, and they start pulling them apart because they
Mm.
don't know. And I think it's that thing, if you apply that logic to every conversation, at a certain level, there are certain things everyone should know about their business. So if I've got this product in front of me, how much does it cost me to make it? What can I sell it for? And how much does it cost me to get it in front of someone?
Mm.
And it's that real like simple insight can tell you so much more about that person and their likelihood of being successful versus someone who just doesn't have that knowledge. But it's also about really being aware of where your gaps are. If you're very much a product focused person and you've not got really any commercial experience or kind of business experience, go and find a mentor.
No,
Because that's the best thing about that is complementing what you know with other people who have got different experiences. Because again, if when someone's looking at an investor deck and they're going, okay, for me to realize some money out of this, I'm probably looking at 5 years down the line minimum, because most equity investments take at least that time to realize anything, if not longer. So I've got to back the team that I'm seeing in front of me to deliver in 5 years' time. And if I'm sitting there and I'm looking at the team and I'm seeing all of these gaps, then the likelihood of me going to invest my money in that is far lower because all I'm seeing is risk.
yeah,
So it's about really that investor mindset of putting yourself in that perspective of it's risk based. So I
mm,
think rather than looking at everything from a nice, fluffy, diagrammatical sense, is go everything you've got missing is risk. And if there are enough risks in that kind of thing, you're never going to raise cash.
yeah,
Even if you've got the best introduction, the best thing in the world, because most things come back to either that or they're going to back the person and they're going to go, you're really, really credible. I really like what you're doing, but you need to acknowledge you need help with these things.
mm.
So I think it is incredibly important to be aware of where your gaps are and try and find people that can help you fill those gaps because a team of more than one of you or two or three of you is far more investable than just one person with a great idea.
No, definitely. No, definitely. But I think it's also that when you're in that situation and you're deep in it yourself, it can be very hard to see that as well, and also understand, like I say, that investor mindset, and look at the people who you've put forward on your team as being a complete team, which actually makes sense. You know.
Yeah, and this isn't we're doing. Obviously, I spent a lot of time with different investors, different lenders, different kind of mentors, business advisors, and we're doing this in terms of the way we're building out our team because we want to achieve something on a much bigger basis than where we start. And you're looking around and going, okay, I don't know a huge amount about marketing, as an example, and go, how can I find someone really credible that can help? That the first question they're not going to ask me is, how much am I going to get for doing this? So, how many people have I come across in my previous kind of life of doing other things, or I've seen something online and I've gone, do you know what? Actually, they're quite cool. They do this quite well. And engaging with those people and going, do you know, what, would you mind sparing 15 minutes to give me a little bit of feedback on this? And I found that that's been so beneficial because more and more people, unless you're getting spammed by huge amounts of people on kind of a lot of social channels, and that as we do more and more, are prepared to kind of give kind of some feedback at least. And I think having real people that you can talk to about things, that their first interest isn't what am I going to get out of this? Because that's the problem for me with advisors and advisory networks is as soon as you get into that thing and going, okay, do you know what, I'll give you a really short consultation. And then what we need to do is you need to commit to spending X, Y, and Z. And I think that's where it's wrong because those people at the beginning don't necessarily know what they need. And you can end up going and spend a huge amount of money to find out the answer to the wrong question.
Mm.
So you almost need that fact finding bit up front, and I think that's also the challenge. If you found it easy to access cash, then it's much more likely you'll go off and spend it on some of these things because you go, do you know what? I want to feel like I'm really credible, and therefore I'll go and find a really expensive advisor to answer some questions for me. But you need to have worked out enough first to make sure you're getting the best kind of use of the money you're spending.
No, definitely. And look, there's always an advisor and a consultant for everything, isn't there? And yeah, I know myself. Look, I used to do a lot of consultancy, and um, most of the time you've just got to turn the work down if you're being honest. But there's not everyone's like that because some people just can't help. It's not within your wheelhouse particularly, or you don't think your work, the work you'll do for them, will actually really bring them results because there's other things wrong in their system which you can't help with. But like, look, there's a lot of people out there, and they just want to take the money. Like, so it's kind of, it is hard. It is hard to find the right people to actually work with, to be honest, on that sense.
Yeah, and I think like particularly in this industry, of one of the things we'd like to try and do is pull together more of a group of people that are prepared to help and support in a similar way to what we are, that can kind of be referenced by PIF as an example and go, do you know what? We'll do these things over every period of time and we'll get some people together. And what we'll do is we'll really focus just on giving back and trying to help these people and answer questions, or it's like a clinic or kind of like an online kind of webinar or something like that. And just bring together people who've got a broad level of experience across a variety of different areas with the overarching aim of just being able to take some of that stuff out the market and go, do you know what? What you need is someone to help you with this. You don't need to go and spend X on doing all that. What you really need to do is, if you look at all the areas you've got in front of you at the moment, you just need to do this. And it's like I spoke to a founder of a business last week, and we're talking through their kind of journey of their retail business, and it's growing, and they've now got these pain points, and it's like there's lots and lots of white noise of lots of things going on, and you go, but how you actually know if you're moving forwards? Because it sounds to me like you're just doing everything. Are you taking a step back and going, does this actually make sense? Because it's very easy to become busy in doing stuff because it's nice to do it or you enjoy these certain bits without realizing if it doesn't make money or is not part of, like, the longer that goes on, the more likely you are to fail.
Mm.
And being able to take a step back is incredibly important. And I think that founder mindset of you just dig in, dig in, dig in, thinking you're moving forwards. And if you're not, then the challenge is massive.
But it's also, like I say, I think for founders as well, it's like, look, you know yourself, like one person can be great at product development, but they don't necessarily understand routes to market. They don't really understand consumer behavior. It's sort of like even things like how merchandising works, how things look on the shelf. I mean, these are all really important parts of running a business. And I think you can sometimes have people who just, like I say, lack those skill sets, and then trying to actually then push them back round can be quite hard. So,
And because I think it kind of touched this earlier, but is that allowing someone to kind of impart on your journey and support you with it is kind of our thing of like, we look at these businesses almost like as as like their children, and you kind of go, do you know what? You're very protective of it. When, like you said, if you're trying to do a retail business on scale and you've got no experience of merchandising and the way your product's going to look on the shelf, and you've just got it there in a brown bottle that is nondescript, then you know it's very, very difficult for that to be successful.
mm,
And I think that's what the undertones to all these things, and kind of like the really strong message has to be, is looking for support. You don't have to know everything yourself. There are lots of people out there that are prepared to help and support businesses. It's just being going into those conversations with your eyes open and making sure it's not just someone out there who's only interested in getting you onto a contract of billing you, but really looking at going and being transparent with yourself, or kind of honest with yourself, of going, I really back what I'm doing, but I know I'm no good at these things. And then thinking about how can I find people that can help with them? Because they might be investors as well.
yeah.
And that's the thing, is you never know sometimes when you meet someone, they go, yeah, I can help you with this. And it's part of, they don't reveal until later on down the line. Oh, actually, I like the idea of this and I can actually help you financially as well. Or they have the network of those that do.
Mm,
Because a lot of strong investment cases usually come from a referral of someone who knows them, or you've agreed you're going to get involved in this, and yeah, I kind of follow a lot of the stuff he does, and I'll kind of put in X because if he gets it and he's prepared to spend some time, because you get different types of investors, those that have got time to actually add value on top of their cash, and those are where it's just money and it's just
yeah.
an investment. And I think that's where really understanding that, but also then being flexible with what you think the business is worth, is key.
Mm,
Because you might go, oh, the company's worth 2 million quid. And that guy comes and goes, well, at the moment, I think it's worth half that. And but I'm prepared to give you some cash and I'm prepared to help you, not just write a check for it. And it's about understanding that some things have got to flex, because otherwise you'd already have the cash.
mm,
So having that understanding and the appreciation of, you can't go into these conversations with a fixed mindset.
yeah.
Yeah, everyone wants to get a great deal and hold valuation as high as possible, but also you've got to realize that that's the difference in a lot of cases between getting a deal or not. Because certain people will go, if you're asking, like, again, Dragon's Den is the best example. If you come in and go, I'm looking to raise 200 grand at a £5 million valuation, most of them are sitting there going, if they're people, because they believe they can add value outside of just their cash, they go, it's not worth my time. And you've
Mm,
alienated 60% of your audience on day one.
yeah,
And I think that's the thing is it's being really open. Like value, everyone kind of it's this thing of going, we're trying to do this at this percentage. That should be an open kind of door conversation of going, this is what we think it's worth. Or even there's a lot of kind of thinking or kind of debate around, do you actually even say the valuation you're trying to raise at? And actually, do you just focus on the amount you're trying to raise? And then the valuation's more of a discussion. There's different mindsets on this depending on who you speak to.
yeah,
Because if you're kind of going, if you're very fixed of this is what we're trying to raise, then it
yeah.
kind of gives you more flexibility.
And the trouble is as well is if you go with a high valuation on your first round, it doesn't give you anywhere to go on your second round. That's the problem. You've got to have made serious strides between rounds to, because like, let's say you start off and you're like, well, I think it's worth 5 million, but then you after invest using that money, you're no further forward, particularly like in terms of like you might be like in terms of profitability. Let's say you might end up having to have a down round, and that's a nightmare, isn't it? For
Yeah, and I think like coming back to all these things, it's having a plan and looking far enough ahead. So if you want to raise X today, but you know for your business to be long term successful, you're going to have a series of rounds,
yeah,
then each of those rounds requires a certain change or step forward to achieve a higher valuation or to raise something a lot more money. And again, being able to work those things back of knowing, okay, for us to do that, we've got to deliver X, Y, and Z. If you don't, and again, it's those reasons of why people don't raise is because you don't have the foresight of going, okay, that's what we're going to have to do. And like you said, if you raise money at 5 million quid today, retail product or whatever it might be, and there's not a vast kind of opportunity, and you come around 12 months later, you spent all your money on marketing, and you've now got to the stage where you've got some revenue to try and go and then raise at a £10 million valuation is going to be much harder unless the stats, and that's again, everything comes back to a lot of data points of going from that point there to that point there. What have we done on all these metrics? And if you don't understand what the metrics are, then it's very difficult to convince someone to give you your money to go and do the next stage. As well as it's better to build from a low base in a lot of cases because it also shows willing on the part of the founder from an investor perspective going, okay, do you know what? More and more people, what is a new, if we were going to say we're going to go and build a a pet product really around maybe some kind of collar with some random benefits, and we've kind of put this business case together, identified there's a niche in the market, we've built some prototypes, we've got some potential customers, but we realize we need cash. What's that business worth today?
it's like it's worth whatever you want to call it, isn't it? Really, that's the problem. Like,
Because it's so early.
yeah,
And that's then the thing. If you're sitting there and you go, do you know what? Most people come back to £1 million valuation on so many things because it just feels like that's a nice place to start. And you get other people that go, oh, it's worth 5 million quid today. And you go, you're just alienating so many people. It's about having that maturity of understanding and going, okay, this is what we think. Nothing's guaranteed, nothing's set in stone. And I think it's also about being real, that to try and find that first load of cash is incredibly difficult
yeah,
unless you're in the privileged position of you've got a very well educated, financially strong network of people around you that can afford to invest in your
yeah.
startup. But in most people's cases, you don't have that luxury.
Yeah, and look, I mean, look, I mean, to be honest, look, that's one of the benefits of, let's say, SEIS, for example, is the fact that people can have a punt and actually not really risk very much money if you're a high taxpayer. But it always like blew my mind when I first started getting involved with investment led businesses, and you're like, your business worth what? Do you know what I mean? And like, because the Dragon's Den thing is true, but it's true in reverse of what I thought it would be. It's sort of like people coming and saying my business worth 500,000. And like, truth is, if they were going to actual investors, they'd be blowing. They'd be talking about 1 million. To be honest, they wouldn't be talking about 500,000. Um, and you look at their projections, and the projections are absolutely nutty. Do you know what I mean? Like, you think you're going to be doing £2 million a year's worth of like turnover on this product. I mean, uh, the addressable market of that isn't even that, to be honest. Do you know what I mean? And you're like, you're already saying you're going to blow, you're going to take all the work and keep blowing because you're looking for this growth projection, which is going to excite investors. So yeah, it's weird. I found the whole thing weird, to be honest, when I first got into it. And especially at that sort of real early stage, to be honest. But I think that's where people are really suffering in terms of getting investment at the moment. Even with SCIS, I think it's still tough to get people on.
Yeah, because obviously SEIS is a great scheme of where obviously businesses can now raise up to 250,000 from it, but you're still looking as though those people who are going to get the benefit of getting half their money back as soon as they subscribe, they've still got to have the cash in the first place. It's not like it's a scheme of where you can invest 10 and the business claws back the other 10 and you get 20 grand off the bat. You've really got to have liquid cash to invest. And I know personally, I don't have loads of friends that one have loads and loads of money in the bank, but two are prepared to invest in lots of these things. I think it's about that mind. There's still a big challenge with mindset, similar to what we talked about with debt, but really around early stage investing and taking on board that risk. Because yeah, you get half back on day one, and then obviously you can get another 30% essentially back later on down the line, broadly, depending on your tax status. That you're not risking a huge amount, but still that mindset of going, even though I can get all these benefits back, and you've still got to have the money in the first place and be comfortable kind of investing it. Because as soon as you've invested it, again, the likelihood of seeing it back 5 to 8 years, something like that, probably on average, if it doesn't go bust.
Yeah.
And when you look at the stats on the number of those companies that do go bust, you can see why a lot of people don't.
Mm.
And that's why it's become much harder.
But like a guy I know who's a big investor, he was saying that his is just a numbers game where it's sort of like, pick 50, like you'll get one winner, you'll get a couple which do okay, and the rest will go bang. So it's sort of, you've kind of really got to be, because it is spread betting really,
Yeah.
to do it effectively. If you just put into one, chances are you're going to lose. It's a bit like, putting a number on a roulette table and saying, well, I'm going to go for 64. Most times you're going to lose.
Mm.
But if you've got like chips on nearly everything, chances are you're going to win more often than not. So it's there really is like a spread betting feeling and like a casino feeling to all of it, to be honest.
Yeah, and I think then you've got to look at it from a perspective going, if we say that everything's based on risk, you go, how can I mitigate that risk to make it more likely, one, that I'm going to attract that investor, and two, that the business is going to succeed? Because just raising investment is one part of the journey. Actually going off and building a business is another. And it's still that really understanding those different risks and how you can kind of come back to it. And I think that's the really important thing here. If you don't understand why your business isn't going to succeed or what the barriers to it succeeding are, then how can you expect anyone to part their own money?
Yeah.
Let alone how do you think you can actually make it a success? If you don't know what the challenges are and you haven't got that foresight or everything else to go with it, then you're kind of setting yourself up to fail from the beginning.
No.
And that's why that really importance about understanding all those things and be really aware of yourself, of all those things that are in the way between success and failure, because failure is so common. And a lot of things, if you understood it at the beginning, you wouldn't spend 3 years getting to a stage where you're going to fail.
No.
Again, it's not as easy as that.
How important do you think it is to have an MVP in place before you go for investment? Like, because obviously there's so many. The big challenge always is that you've got a great idea, you might have the team to do it, but you've got no MVP. But you've got no money as well, and so you can look at it and look, like everybody obviously in an ideal world would want you to have the product ready to sell before they come to you, but this isn't the reality of like a lot of people. So they have these great good ideas, they have a team of people they've put together to do it, but they just need the cash. So how important is that getting
So
the
I think it also depends on the nature of what they're trying to do. So, because also it's about, can you protect what you've created? So if it is just a different style of an existing product, then you probably need to, well, it's much more likely you need something to be able to go and sell and be able to demonstrate the benefits. Whereas if you're trying to create something that is far more original or is formulation based and you've got the research to back it up, and it's just you need to be able to go and commit to the first order of all these things, then it becomes less important because it's really about the understanding what it is you're trying to do. Um, but we've seen massively, again, stepping outside of the pet industry, that you used to, from a tech product perspective, you could used to go and raise money relatively easily for a good idea.
Yeah.
Now, because of all the tech and the AI innovations out there that mean that you can take an idea into a fairly simple prototype in a very short space of time for next to no money, the expectation there is you've done that and you can kind of go and demonstrate how it works. So yeah, I think that more and more now their expectation, depending on the product, is that you've got something because it come well can you protect it as well?
Mm.
So if it is just a novel kind of brand on an existing product, where's your real point of differentiation?
Yeah.
So you think about really simple example of LinkedIn from a product perspective is really, really simple to replicate because technically it's just a networking site. But the value proposition and the value there and the way it's protected is because you've got this huge volume of users. Again, if you're going to try and do something similar to it, you're not going to raise money to go and build that audience in the first instance because people are going to go, why? Why are
Mm.
you doing that? Like, there's not. So, really having that awareness of what you're trying to do, who's going to buy it, and that expectation of how far are you away from getting it to market. Because also, those things that are going to cost a lot of money just to get to a stage of where you've got an MVP are far, far more difficult now because people want to see you getting to revenue to get to the next stage.
Yeah.
So I think it's just being mindful and open to what the journey looks like, what the product journey looks like. Is it a physical product? Is it a brand play on something that's already out there? Where is the underlying value of the proposition? Whereas if it's a formula for something of where you can, from an IP perspective, protect it, and also from a brand perspective, can you protect the brand? Is it something that someone else is already using? And the other things that go around the edges. It's just really about understanding it all.
Yeah.
But the more you can do at whatever stage you're at, the better, isn't it? I
Right.
think because you might attract a higher valuation.
Also, I've always found as well that people don't like physical product as well much in the investment space compared to, let's say, tech product. I've always found that, like, I think we touched on it at the beginning where we said, like, everybody's obsessed with AI at the moment, but I've always found that, like, people, like, just as a scalability thing, like a non-physical product is always so much easier to get investment on because they can see a clear scalable path to that. And how would you say is the best way to, like, because I'm kind of dubious about a lot of these tech products anyway, especially in the pet industry. But how can you convince somebody with a, a physical product that it is a scalable thing which warrants investment?
So it really comes back to valuation. A lot of that is going to be the difference in valuation. So you'll see that again, if you take examples of where there's an element of tech to something and the implication that has for valuation on what a sort of business is worth, same as if it's people trying to get to using ARR as a way to value a subscription business when ultimately it will be retail. It's about really understanding from those perspectives. But if there's a logical kind of journey with a physical product, then it's really around what that journey looks like. So to scale is going to generate all these opportunities, and we've got the wholesale network to deliver that. We've got the margin structure that allows it, and really breaking down what are the success factors for that, and really highlighting that back to that investment journey. If anything, that should be a much lower risk investment than some of the things that are tech, because tech, you've got the physical cost of building it. You've then got the awareness and all these kind of other things. Whereas just taking a product out to market via a wholesaler and opening up all these different territories and then being able to go internationally should be far more simple.
Mm.
But it's about the story making sense and not trying to apply a tech valuation to a product based business because it just doesn't work in the same way. and also that awareness of understanding what likely returns are going to be, rather than thinking you're going to get tech-like returns on a product-based business, because you're just not. It's not going to work like that. And I think having that maturity of understanding is kind of a big thing. Um, and not necessarily everything has to be 50 times return. Like some people, certain investors will go, do you know what? I'm going to get 10 times money back. It's fairly low risk because it's product based. They've already built a business to a certain size. All they want to do is take what they've already done and grow it. They're not asking for huge amounts of money. It's not a really high valuation. Kind of the traditional metrics of how you'd value a business stack up. It's just that it's all about that investor mindset of, am I an investor who's sitting there looking to make 30 times on every investment, or am I someone who's actually, do you know what, they're fairly lower risk, but I'm looking for 10 to 1 on
Mm.
everything I do, or kind of a collection of somewhere in between.
Yeah.
But there should be no reason why. Also, those kind of businesses that have got a product and just want to go and scale the product led businesses might be more likely to secure debt financing as well.
Yeah.
Because again, what you're going to spend the money on is a fairly replicable process. So that might also be an avenue, which again is even better. If you can leverage cash without giving away any equity
Yeah.
and get access to it, there are a lot of government based institutions of where at the earlier stage or slightly more aggressive um, lending market that can still help.
Yeah.
So it's a variety. Yeah, obviously, the further developed you are, the better. But also, any kind of business, as long as it makes sense, has a chance of getting funding. It's just finding the right person or people or funds, or
Yeah.
and trying to help the awareness of the different places you can raise cash from.
Yeah. Yeah. No, definitely. No, look, it's this. I think this is something we could talk about all day, Scott.
Very true.
Yeah.
We've all got stories.
Look, if people want to get hold of you, like, and actually talk to you about, potentially raising funds for their business, what's the best way of doing it?
So LinkedIn or email scott at comparefunding.io. We have bought the .com, but we don't use it yet. And genuinely, I'll try and help where I can. So yeah,
No, thanks a million for coming in. Really appreciate it. And like,
no, real
look,
pleasure.
I feel like we only scraped the surface in a lot of ways, but it's a fascinating topic, man. Thanks a
Yeah,
million,
no,
dude.
fantastic. Thank you.